We're joined by David Konrad. He's a large cap and super regionals banking analyst at KBW, which is a Stifel company. Great to have you with us, David. First, I wanted to ask you about what the FDIC came out with in terms of the fees that will be charged to banks to cover the insurance fund there, and where it would have the most negative impacts. I would imagine the large banks, not much of an impact, but there's probably a middle ground which would see an actual impact on earnings.
Yeah, I think it's pretty manageable. We just kind of did the math recently. You know, actually my coverage, I think, is paying about 75% of the total fees, but it looks to be around 4% dilutive to EPS each of the next in 24 and 2025. Embedded in our estimates, we kind of estimated it would be 3%. So relative to our expectations, it was pretty close and pretty manageable.
I wanted to ask you what your thoughts were also when it comes to where we are in this crisis. I mean, it feels like it's stabilizing according to, I mean, if you take the word of a lot of officials out there, it's contained. But if you take a look at how the regional banks are trading, it is not. And when you take a look at what PacWest said just a few days ago, on March 4th, it said the bank has not experienced any out-of-the-ordinary deposit flows following the sale of First Republic. Then today it says deposits declined by 9.5%. This is a matter of a few days here. And that's how quickly the situation can change. So how do you sort of assess where we are right now, David?
Well, a couple things here. I mean, unfortunately, social media has had a big influence on some of the deposit flows here, and that kind of happened. PacWest also announced that they were exploring strategic alternatives, perhaps a sale of the company, sale of assets, and all that really created another kind of contagion in the stock. You know, with the stock down, at a $4 handle, things are very fluid there. But I think today was really, really important in the sense that Western Alliance was actually flat for the day. And those two stocks have really moved in tandem with kind of this contagion. And the fact that Western Alliance came out and said, actually, our deposits are growing, and that stock was flat, while PacWest was down 25%. To me, that tells me we're kind of getting a little bit more firm footing in the group.
David, it seems to me that this is a stock thing. Doesn't seem systemic in so much it's going to derail the economy. It's not a leverage thing. But if credit is more difficult to attain for small and medium-sized businesses whose lifeblood are these small and regional banks, that's going to have a huge effect on the economy at some point. It's not tomorrow, but it's in the weeks and the months to come, I would think, because as these banks sort of fall by the wayside, and listen, I don't think we're anywhere near being over, the bigger banks will get the deposits. The bigger banks don't necessarily have all that interest in servicing these things, and it's going to be more expensive for people to do business. Thoughts on that?
No, I think that's right. I think, kind of a segue into the Blackstone article, looking at, we did a report that said banks around 80 billion to around 200 billion are really kind of in no man's land. They have most of the new regulations hitting them. When you think about the higher capital standards that are facing some of these banks, as well as, and more importantly, the increased liquidity coverage, we do think there is going to be somewhat of a credit crunch. We've taken out buybacks and loan growth across the majority of the super regional banks.
So which banks could you see Blackstone wanting to partner with? What kind of bank? I mean, ultimately, is it going to be Blackstone to the rescue here for some of them?
Well, listen, I mean, the shadow banking and the alt managers have been around for a while. They've seen extraordinary growth in private credit. It's actually worked. It's not a zero-sum game. They've actually worked together with the banks. And I think with these increased capital and liquidity, banks have to readjust their capital allocation. And so I think it's going to be more and more difficult. Historically, the insurance companies have bought a lot of commercial real estate. That's a little bit of a tougher proposition right now. I think they're probably near their limits there. Where I think there could be an opportunity is on the consumer side. We've seen a lot of super regional banks, Fifth Third Regions, Citizens Financial are starting to shed the auto book with given the risk-adjusted returns. And so I think they're looking to unwind some auto. They're also growing point-of-sale finance, home improvement businesses. But that growth is so rapid, it's really challenging for them to portfolio it all. So I could look to some of those asset classes being, partially moved with Blackstone and into the insurance business. I mean, they also have accounting issues with those businesses. The CECL accounting makes it very dilutive to grow those businesses up front. You know, tying that together with Goldman's announcement that they might look for a sale for Green Sky, all that kind of fits together to those home improvement loans.
Yeah, I mean, taking a longer-term look at this whole thing, David, I mean, do you think one of the lasting impacts of this credit crunch that is on us, that's about to come and get tighter, is this move into private credit becoming even bigger? And so that will take on more of the risk in the system as opposed to the banks doing it.
I think that's right, and I think that makes us feel better about the banks in terms of their credit quality near term. But that is a systemic risk in itself, and I don't think banks will be immune if there is a downturn in the private shadow banking market in terms of credit. I think that it'll all be kind of tied together a little bit. But the direct exposure for banks, you know, is actually pretty modest. I mean, the shadow banking market has about 85% of the leveraged lending market there. So that's an idea of kind of the risk that's off the bank's balance sheet.